Thanks very much for being here, and I'm pleased to be joined by Congressman Brad Sherman. Here is the reality of the American economy today. Despite a huge increase in technology and productivity, millions of American workers are working longer hours for low wages, and median family income is almost $5,000 less than it was in 1999. While the middle class continues its 40-year decline, we have 45 million people living in poverty and the highest rate of childhood poverty of any major country on earth. Half of the American people have less than $10,000 in savings and have no idea as to how they will retire with dignity. The real unemployment rate today is not 5.5%, but it is close to 11%. But here is another reality in terms of the American economy. Today, 99% of all new income is going to the top 1%. The top 1/10 of 1% now owns almost as much wealth as the bottom 90%. During the last 2 years, the 14 wealthiest Americans saw their wealth increase by $157 billion, which is more wealth than is owned by the bottom 130 million Americans. In 2 years, wealth increased for 14 people by more wealth than is owned entirely by the bottom 130 million Americans. And in the midst of all of this grotesque level of income and wealth inequality sits Wall Street. As we all know, the greed, recklessness, and illegal behavior on Wall Street drove this country into the worst recession since the Great Depression. Millions of Americans lost their jobs, lost their homes, lost their life savings, lost their ability to send their kids to college. The middle class is still suffering from the horrendous damage huge financial institutions and insurance companies did to them in 2008. I voted for the Dodd-Frank legislation, but let us not kid ourselves. Dodd-Frank was a modest piece of legislation. Dodd-Frank did not end much of the casino-style gambling that takes place on Wall Street. In fact, much of this reckless activity is still going on today. It seems like almost every day we read about one giant financial institution after another being fined or reaching settlements for their reckless, unfair, and deceptive activities. Can't pick up a paper without reading about one scandal after another. In fact, since 2009, huge financial institutions have paid $176 billion in fines and settlement payments for fraudulent and unscrupulous activities. Bank of America has paid over $57 billion. J.P. Morgan has paid over $31 billion, and Citigroup has paid over $12 billion in fines and settlements. Bank of America has been fined for foreclosure abuses, selling toxic mortgage-backed securities, LIBOR manipulation, and currency rigging, among other things. It should make every American extremely nervous that in this weak regulatory environment, the financial supervisors in our country and around the world are still able to uncover an enormous amount of fraud on Wall Street and other financial institutions to this very day. I fear very much that the financial system is even more fragile than many people may perceive. This huge issue simply cannot be swept under the rug. It has got to be addressed. During the financial crisis of 2008, the American people were told that they needed to bail out huge financial institutions because they were too big to fail. Yet today, three out of the four largest financial institutions in this country, J.P. Morgan Chase, Bank of America, and Wells Fargo, are 80% larger than they were on September 30th, 2007, a year before the taxpayers of this country bailed them out. So we bailed out the largest financial institutions in this country because they were too big to fail. And today, 3 out of the 4 largest are now much, much larger than they were when we bailed them out. Incredibly, during that time, J.P. Morgan Chase has increased its assets by more than $1 trillion, Bank of America by more than $500 billion, and after Wells Fargo acquired Wachovia, it has more than tripled its size. In other words, if any of these financial institutions were to fail again, the taxpayers of this country would be on the hook for another bailout, perhaps even larger than the last one. We must not allow that to happen. No single financial institution should be so large that its failure would cause catastrophic risk to millions of Americans or to our nation's economic well-being. No single financial institution should have holdings so extensive that its failure would send the world economy into crisis. If an institution is too big to fail, it is too big to exist, and that is the bottom line. And let's be clear, the reason we are here today is not just because of the danger these institutions pose to taxpayers. That unto itself is an enormous issue. But there is another issue as well. The enormous concentration of ownership within the financial sector is hurting the middle class and damaging the economy by limiting choices and raising prices for consumers and small businesses. Today, just 6 large financial institutions have assets of nearly $10 trillion, and that is equivalent to nearly 60% of the GDP of our nation. These huge banks handle more than 2/3 of all credit card purchases, write over 35% of the mortgages, and control nearly half of all bank deposits in this country. That simply is too much concentration of ownership and too much power. If the American people are wondering why tens of millions of Americans are being charged interest rates of more than 20% on their credit cards, more than 20% on their credit cards, while big banks can receive virtually zero interest loans from the Fed, the lack of competition in the banking industry is a major reason for that. If Teddy Roosevelt were alive today, I think I know what he would say. And what he would say is, these financial institutions are simply too big. We have got to break them up, and he would be right. The bill that I am introducing today with Congressman Brad Sherman would require regulators at the Financial Stability Oversight Council to establish too big to fail list of financial institutions and other huge entities whose failure would pose a catastrophic risk on the United States economy without a taxpayer bailout. This list must include, but is not limited to, J.P. Morgan Chase, Bank of America, Citigroup, Goldman Sachs, Wells Fargo, and Morgan Stanley. All of these financial institutions have already been deemed systemically important banks by the Financial Stability Board, the G20 body that monitors and makes recommendations about the global financial system. Within a year, the Treasury Secretary would be required to break up financial institutions on this list so that they cannot cause another financial crisis. Importantly, under this bill, none of the institutions on the too big to fail list would be able to receive a taxpayer bailout from the Federal Reserve, nor could they gamble with the federally insured bank deposits of the American people while they are on that list. I am delighted that this legislation has been endorsed by the Independent Community Bankers of America, representing more than 6,000 community banks. What the independent community bankers understand is that the function of banking should be boring. Boring. The function of banking should not be about making as much profits as possible, gambling on derivatives and other esoteric financial institutions. The function of banking should be to provide affordable loans to small and medium-sized businesses in the productive economy. The function of banking should be to provide affordable loans to Americans who need to purchase homes and cars. Wall Street cannot be an island unto itself, separate from the productive economy, whose only goal is to make as much money as they can. For me, this position that I'm holding today is not new. In 1994, I cast the only no vote on the House Financial Services Committee against legislation that allowed large out-of-state banks to acquire locally owned community banks. In 1999, I helped lead the opposition against repealing Glass-Steagall that allowed commercial banks, insurance companies, and investment banks to merge. And I was one of the leading opponents of the efforts of Alan Greenspan, Robert Rubin, and Larry Summers, who all told us how wonderful it would be if we deregulated Wall Street back in the 1990s. And that is where we are today, and I'm delighted to be working with Congressman Brad Sherman, who has done a great job on this issue. Brad?
Thank you, Bernie. Hello, I'm Brad Sherman from California's best named city, Sherman Oaks. It's a pleasure to be with you. I endorse the Senator's view that banking should be boring, and as co-chair of the CPA caucus, I think I speak with some authority on that issue. Since 2009, Senator Sanders and I have worked to pass legislation to say too big to fail is too big to exist. This is the third time I've introduced this legislation in the House. This is the third time he has introduced such legislation in the Senate. We are joined today only in spirit by Alan Grayson of Florida, who is co-sponsoring the House bill this year, just as he did 2 years ago. We're in the exact same room we were in 2 years ago. There are only two differences. One is that the big banks have gotten even bigger. I think Senator Sanders gave you statistics. My statistics are that that the biggest banks are 38% larger than they were at the time of the meltdown. The second change is that for some reason there are a lot more of you here today than there were 2 years ago. Now, in 2008, we learned that if Wall Street calls and says, bail us out, or we're going to take the economy down with us, then even if there is no statutory provision for bailouts, as there really isn't today, Congress will pass, as we did in 2008, a bill mandating the bailout. So too big to fail means you will be bailed. That isn't capitalism. That is socialism for the wealthy. Now, what does it mean to have the largest institutions in a situation where everyone on Wall Street, everyone in the financial capitals of the world knows that if one of those biggest institutions is about to fail, they, and more importantly, their creditors, will be bailed out 100 cents on the dollar? According to an IMF economic paper, it means they have an 80 basis point lower cost of funds. That's 0.8%. That may not sound like a lot. It's less than 1%, you might say. But Bloomberg did an analysis based on that paper and said by having a lower cost of funds, these largest financial institutions generate, from that one source alone, $83 billion in profit, which is roughly equal to their entire profit. So in the financial services industry, lower cost of funds of even 1 or 2 basis points, let alone 80 basis points, can be decisive in beating your competition. Now, I don't want you to go back and write that a couple balding, progressive congressmen are the...
Speak for yourself.
are the only ones supporting this concept. You can't characterize this as a departure from traditional capitalism. It is supported, as the senator pointed out, in concept by the 6,000 banks represented by the Independent Community Bankers Association, which is roughly 90% of the banks in this entire country. This is solid capitalist economics. And it's one step beyond current law. Current law allows the regulators, particularly led by the Secretary of the Treasury, to break up those institutions that are too big to fail. The problem is that authority has not, and frankly never will be used. I've sat at hearing after hearing with several secretaries of the Treasury, all of them saying they're not going to use that authority. So this bill goes one step further and says too big to fail doesn't mean you're eligible for breakup. It means you must be broken up. What does this bill do for the United States? First, we avoid the situation where an institution can demand a bailout, where a single institution can pose a systemic risk to our economy. Second, we avoid not only too big to fail, we avoid too big to jail. You may remember when Attorney General Holder said that he was unwilling to prosecute certain banks, or reluctant to do so perhaps, because that action could imperil the entire U.S. economy. No one said that when we had the savings and loan crisis, because the institutions involved were not so critical to our economy, and it did not pose a systemic risk. Third, we need to be fair to medium and small banks and other financial institutions. When you give the largest banks an 80 basis point advantage, you put them in a position where you will see a contraction, and you have seen a dramatic contraction in the small and medium-sized banks. That's not just important to those small businesses and medium-sized businesses in the banking business. It is critically important to our entire economy, because the lifeblood of our economy is small and medium-sized businesses. Small and medium-sized banks provide capital to small and medium-sized businesses. Giant banks, and we had testimony from Jamie Dimon on this. He said, we couldn't find small and medium-sized businesses in the United States to lend to, so we had excess funds. We sent it to London, which, as you'll remember, those funds were eaten by a whale. So this bill is solid capitalist principles applied to a sector of the economy where the implicit federal guarantee gives a few institutions a tremendous unfair advantage in our economy that distorts our economy and tremendously undermines the ability of small and medium-sized businesses to get the capital they need. This bill will require that these institutions break themselves up, and of course, if they don't, the government is given the authority to do so. I think they'll do it on their own. And the question is, well, can they do it? Is it too tough to split themselves up? One note from the world of biology. A protozoa is a single-celled animal. When it gets a little too big, it splits into two healthy protozoa. If protozoa can do it, the finest minds on Wall Street should be able to do it as well. Thank you. Let's take some questions.
Senator Sanders, there have been a number of bills introduced over the last couple of years to address the too big to fail issue, and none of them have really gained any sort of traction. Is there any reason to think that this bill would somehow fare better?
Well, I think you're right. A number of good bills have been introduced by senators and members in the House, and we recognize that Wall Street is extraordinarily powerful. And when Wall Street tells the members of the Congress not to do anything that will damage their interest, most members of Congress adhere to that. My own view is that what Brad and I are talking about today makes eminent sense to tens of millions of Americans who absolutely do not want to go through what we went through in 2008 and 2009, who want to see a more competitive financial system. And we're going to reach out to the grassroots and have support, I think, from a lot of grassroots organizations to put pressure on Congress. But what you're really saying, and it's a good question, can we pass legislation in the United States Congress that Wall Street opposes? And at this particular time, I think you're right. It's going to be a tough fight. Yes, ma'am.
Is it fair to associate Hillary Clinton with some of the policies that created these conditions, given that it was her husband's administration that presided over?
Honestly, not here to talk about Hillary Clinton. If you want to ask Secretary Clinton her views on these issues, you're obviously free to do that. Yes, sir.
The Dodd-Frank Act included a resolution procedure for too big to fail banks that fail. Why do you think that won't work?
Well, I think Brad Sherman, stated it pretty well. Under certain conditions, banks could be asked to be broken up. What we're saying is, if in fact it is determined, and we know this to be true, that a certain number of very large financial institutions, if they fail, would do systemic harm to our economy, they will be broken up. We're not asking, we're telling it. We're saying now, straightforwardly, that these banks are too big and they have got to be broken up.
If I can
Sure.
chime in on that. There are those who would say that if an institution was about to go under, the management would lose their jobs. And that may be the case. But it's like going to Vegas and knowing that if you win the bet, you make millions, and if you lose, well, you're out of a job. But if you have a net worth of tens of millions of dollars already, that isn't a tragedy. What influences the economy is the belief that is nearly universal that the creditors of these institutions will be bailed out 100 cents on the dollar. That is why the capital markets provide capital to these institutions at 80 basis points or 0.8% less than they would if they were being evaluated strictly on the level of risk reflected in their balance sheet. And so it's nice that we have a more systematic approach to doing in the future what we did in a less systematic way at the end of 2008. But as long as that cost of capital subsidy exists, you have the economic distortions we're talking about.
Spoken like a true CPA. Okay. Yes, ma'am.
Yesterday, the DNC announced that there would be 6 debates for candidates, but they also said that those candidates can only participate in their sanctioned debates. Do you plan on participating?
Okay, let me focus on this issue. Maybe we can talk about that one later, okay? All right, very good. Okay, thank you all very much. Take care.